The supply just ran out. November 27th, the CME halted silver trading mid-session. They called it a cooling failure, a technical glitch. But traders know what that really means. Reports suggest the largest banks in the world sold approximately 250 million ounces of silver they may not actually own. And now someone's demanding delivery. In the next 11 minutes, I am going to show you why Bank of America's projected 65 target might be catastrophically conservative and what happens when the world's most critical industrial metal simply runs out. December 4th, silver hovering near 5,965 and all. Bank of America analysts project 65 by 2026. But here's what they're not telling you. The physical metal appears to be vanishing, and I'm going to show you exactly who's scrambling, why banks may be trapped, and the 3 catalysts hitting in the next 30 days that could potentially push this past 70. By December, near 5,965, roughly a 101% gain in 1 year. Compare that to gold up about 60%, the S&P 500 approximately 15%. Silver essentially doubled while everything else crawled. And this is only the second time in history silver's done this. The only year that performed better, 1979, when silver surged approximately 435%. But that was the Hunt brothers situation, market manipulation. It crashed spectacularly. This time it's different. It's not manipulation, it's mathematics. More than all of 2024. In November alone, approximately 15.7 million ounces inflows happened 9 out of the last 11 months according to market data. That's not retail FOMO. That's institutional money, pension funds, sovereign wealth funds, the players who moved billions without headlines. And they apparently started accumulating 9 months ago. Ask yourself, what did they see back in March that nobody else did? What data crossed their desk that didn't make mainstream news? Total ETF holdings now estimated at 1.13 billion ounces, worth approximately $40 billion. That's reportedly a record, the highest in history. You know, when the previous record was set, 1979, right before the Hunt brothers squeeze sent silver toward $50 and the entire commodity market imploded. Pattern recognition isn't conspiracy, it's survival. And the pattern right now is screaming. Because while Wall Street was watching stocks, while crypto grabbed headlines, something appears to be breaking in the physical market. The London Bullion Market Association, the LBMA, the center of global precious metals trading, they used a phrase in November that should have been front-page news: state of seizure, not tight market, not supply constraints. Seizure, that's medical terminology that suggests the system is failing, convulsing, shutting down. And here's some evidence. Lease rates, the cost to borrow silver for just a few weeks, reportedly spiked to approximately 39% annualized. Let that sink in. Banks are allegedly paying credit card level interest rates for temporary metal loans. Why would anyone do that? Because they may have sold silver they don't actually possess. Futures contracts, derivatives, promises, and now someone wants delivery. Now someone's calling their bluff. Market data suggests the COMEX had around 130 million ounces in 2021. Today, reportedly under 30 million. That's approximately a 78% collapse in 4 years. Industrial demand alone burns through an estimated 700 million ounces per year. 30 million divided by 700 million annual demand. That's enough for roughly 2 weeks of industrial consumption. 2 weeks! A Friday, low liquidity. Silver was trading around 54, climbing fast. Then it spiked hard and suddenly trading stopped. They did it to GameStop when retail squeezed hedge funds. They did it to nickel in 2022 when a Chinese trader couldn't cover his shorts. And now they did it to silver. You can manipulate paper prices for a while. You can halt trading. You can issue press releases. But you cannot print silver. You can't create it from nothing. And when paper collides with physical scarcity, paper always loses. So why can't this stop? Structural deficit. This is reportedly silver's 5th straight year running a deficit, meaning demand exceeds supply. 2021 deficit, 2022 deficit, 2023 deficit, 2024 deficit, 2025. Projections suggest 149 to 215 million ounce deficit. Markets normally rebalance. Prices rise. Miners increase production. Supply catches up. Econ 101. But here's the problem with silver. Industry sources indicate it takes approximately 10 to 15 years to open a new mine. From exploration to permitting to environmental reviews to construction to first production, a decade minimum. And the last major silver mine opened around 2019, 6 years ago. Because silver spent the 2010s stuck around $15 to $25, miners couldn't justify new projects. Banks wouldn't finance them, so projects got shelved. And now, even with silver near 60, those projects are still an estimated 8 to 10 years away. Environmental reviews don't speed up because prices spike. Community opposition doesn't evaporate. Government bureaucracy doesn't suddenly move faster, which means supply is essentially fixed until at least 2032. Meanwhile, demand growing every year. Solar installations doubling, EV production tripling, AI infrastructure exploding. And here's the critical part. This demand isn't optional. It's mandated. The US Inflation Reduction Act requires massive solar build-outs. The EU's Green Deal has renewable targets member states must hit. China is reportedly installing solar faster than the rest of the world combined. These aren't suggestions. They're laws backed by subsidies, tax credits, penalties for non-compliance, which means solar manufacturers have to buy silver no matter the price. Because if they don't, they breach contracts, lose subsidies, face lawsuits. The demand is locked in, contractual, legally mandated, and the supply appears to be gone. Now add one more piece, the Federal Reserve. Next week, they meet. Markets are reportedly pricing in approximately an 89% probability of a quarter-point rate cut. Why does that matter for silver? Because precious metals historically trade inverse to real interest rates. When rates drop, the dollar tends to weaken. When the dollar weakens, commodities priced in dollars typically rise. It's automatic, mechanical, and according to reports, Kevin Hassett, former Trump economic advisor, is being considered for Fed chair. Hassett is known as a dove. He's reportedly in favor of faster rate cuts, more stimulus. If that happens, if the Fed pivots more aggressively, the dollar's purchasing power could erode. And when the dollar erodes, people historically flee to hard assets, gold, silver, real estate, commodities. Let me show you how this played out before. Palladium 2020. Most people have never heard of it. It's used in catalytic converters for cars. No substitute. For years, production was relatively flat. Demand rising slowly. Small deficits. Nothing alarming. Then COVID hit. Mines shut down. Supply chains broke. Suddenly, car makers couldn't get palladium. Prices went from around $2,000 an ounce in early 2020 to over $2,900 by March 2021. Approximately a 45% surge in 1 year. And here's the key. Even after mines reopened, even after COVID restrictions eased, prices stayed elevated. Why? Because once industrial buyers realize they can't trust the supply chain, they overbuy. They stockpile. They secure multi-year contracts at any price. The shortage becomes self-fulfilling. Palladium never came back to 2000. It stabilized around 2,400 to 2,600, a permanent repricing. Now, look at silver today. 5 straight reported deficits. Solar consuming an estimated 350 million ounces. EVs, AI, military, all needing silver with no substitutes. Same pattern, except silver's market is 10 times larger and the stakes are 100 times higher. Which brings us back to Bank of America. October 2025, they published a significant report. 2026 forecast approximately $65 per ounce. Average price around $5,625. Bank of America doesn't typically make moonshot calls. They're conservative, risk-averse. For them to publish a $65 target suggests their analysts saw something that made caution impossible. What did they see? The deficits, the inventory collapse, the inelastic industrial demand. But they also saw something else. Capital flows. When institutions like BOF publish bullish targets, it's often because their clients are already buying. The research report isn't necessarily a prediction. It's a justification. It gives pension funds and wealth managers cover to increase allocations. See, Bank of America Project 65. We're not crazy. We're prudent. And once that starts, more allocations, more buying, more supply pressure. Then Citi reportedly followed with a $62 target within 3 months. Then UBS, then SHBC. This isn't consensus forming. This appears to be a stampede beginning. And stampedes, once they start, you can't stop them. Solar manufacturers won't stop building panels because silver hits 80. They'll just pay 80. EV makers won't halt production because silver hits 100. They'll pay 100. So how high does price have to go to ration the available supply? 70, 90, 120. We're in uncharted territory, and that's where fortunes can be made. This appears to be a once-in-a-generation supply shock, and supply shocks don't resolve peacefully. They resolve through pain. Someone gets hurt. Either the shorts who may have sold metal they do and have, or the manufacturers who need metal they can't get, or the investors who waited too long to position. Someone always loses in a squeeze. Because here's the reality. If Bank of America is right and silver hits 65 by 2026, that's approximately another 10% from here. Nice, but not life-changing. But what if they're wrong? What if 65 is just the first leg? What if the real repricing happens when industrial buyers realize the COMEX is nearly empty and start securing supply at any cost? What if the market goes bideless? No sellers, only buyers. We saw it with nickel in 2022, around $20,000 per ton to $100,000 in 48 hours. Approximately a 5x move in today's because someone had to deliver metal they didn't own. Silver's market is bigger, more liquid, but the mechanics are similar and all the warning signs appear to be there. Backwardation, lease rate spikes, inventory collapse, trading halts. These aren't normal. These are potential endgame signals. But crises create opportunities. If you understand what's happening, you can position for it. Not as a speculator, not as a gambler, but as someone who recognizes value before the crowd does. Silver at 60 might seem expensive until it is 80, and 80 will seem expensive until it is 120. Because in a true supply shock, price doesn't matter. Availability matters, and availability appears to be disappearing. The people who positioned 6 months ago around 30 up roughly 100%. The people who position now around 60 might catch another 50 to 100% potentially. The people who wait until mainstream media is running silver mania segments, they'll likely be the exit liquidity. That's how these moves typically work. Early adopters win, late adopters chase, and chasers often arrive at the top. The 3 catalysts to watch in the next 30 days. 1. Fed rate decision December 18th. Markets currently pricing an approximately 89% probability of a cut. 2. January options expiry on the COMEX, potentially forcing physical delivery. 3. Chinese New Year in late January, when Asian demand historically surges around 40%. 3 events, 30 days, and an estimated 30 million ounces of available supply. I'm tracking this story every single day because silver at 60 may just be the beginning of a much larger shift. A shift in how we value hard assets in an era of aggressive monetary policy. A shift in how we think about scarcity when abundance narratives collapse. A shift in who holds power when the things we need start running out. Next video I'm breaking down the exact inventory tripwires to watch. The levels that'll tell you if this is a bull market or full-blown mania, because there is a difference. And knowing that difference could be the difference between profit and pain. Subscribe right now, not because I'm selling you something, but because mainstream media typically won't cover this until it's too late. They'll run the story when silver hits 100, when the banks have repositioned, when the smart money has exited. You don't want to be that person. You want to be the person who saw it coming, who understood the fundamentals, who acted on data, not hype. Silver hit approximately 59.65. The supply appears to be gone. Bank of America projects 65, but the physical market may be screaming something louder. It's suggesting that 65 might just be the warm-up. And if you're paying attention, if you're reading the signals, if you're following the money, you already know what could come next.